42% of startups globally are threatened in the red zone. It means that they have less than 3 months of runway in hand. So going by that, 4 out of 10 startups are likely to perish in the next 3 months if they do not raise additional funding. That's according to a report by global advisory and research firm Startup Genome. The increase in companies classifying themselves within this red zone has risen exponentially by 40% since December. In fact, 74% of the 1,000 startups surveyed across 50 countries have seen a decline in revenue since the beginning of the crisis. 16% of enterprises report a whopping 80% drop in their earnings. The study of the COVID-19 impact on startup ecosystems has found that 3 out of every 4 startups work in industries that have been severely affected by the pandemic. For entrepreneurs accustomed to building a business in good times, the economic impact from COVID-19 has now quickly moved from a mere setback to a full-fledged existential shock, which has sent business plans and strategies for a toss. Hello and welcome to Young Turks, India's longest running show on startups and entrepreneurship. I'm Shireen Bhan. Over the last few weeks, we've been speaking to top investors and founders to create a crisis playbook for startups. And joining me today is the new team at the helm of Indian Private Equity and Venture Capital Association at IVCA, Renuka Ramnath, chairperson. She's also the founder and CEO of multiple alternate in asset management. Also with me, Karthik Reddy, the vice chairman at IVCA. Karthik is the co-founder and managing partner at Bloom Ventures. Renuka and Karthik, congratulations and thanks very much for joining us. It's going to be a trial by fire for the two of you. You take over at very interesting times. Renuka, let me start by asking you about what the mood is within the Indian startup ecosystem. What we were just reading out by way of numbers was the mood across 50 different countries. Startup Genome putting together data after surveying startups across 50 different countries, and a very worrying picture that a large majority of startups find themselves in the red zone with just 3 months of runway as far as cash is concerned. What's the story looking like here in India?
So it won't be vastly different, Shiri. Of course, in multiples, we don't have too many startups. But I would say that I have gone through this crisis in 2001 when the whole world collapsed and the equities collapsed. I've gone through this crisis in 2009 when we had the global financial crisis. All I can say from my past experience and from everything that's going on now is the good ones which have a runway for a future in the post-COVID scenario will definitely find the money.
Yes, the good ones will survive and hopefully find the money. But Karthik, where are you seeing the most impact? Because again, it's the sectors, aviation, hospitality, travel. I mean, these are the sectors which have been decimated because there's been a complete demand evaporation, at least as of now. But then there's other opportunities. If you look at what's happening on the SaaS side, on distance education, on gaming, I mean, that's where the silver lining lies. So how are you reading what's going on at this point in time?
I think you're absolutely right, Shireen. I don't think it's all doom and gloom. I think it's a harsh kind of reset of where most companies need to imagine a new future. It's a very interesting time because I don't think there's been a singular point in our lifetimes where customer behavior gets accelerated or reset at this scale across the world. Right? And so it forces everyone to think about what a post-COVID world would look like. And that means that irrespective of whether you have a lot of money in the bank, whether you have tailwinds or silver linings, you need to think afresh on how do you take advantage of this phenomenal opportunity. Of course, if you do not have capital for that, if you don't have the resources, you are unlucky not to have raised in the last 2 quarters, then the fate and odds are against you. And I think there are 3 dimensions on which you should look at the sort of opportunity/problem set. One is, were you lucky enough to raise capital in the last quarter or 2? And I think, at least I can speak of our portfolio. I think about 1/3 to 40% of them were lucky. Okay. And so they have no excuse to not be alive on Jan 1st, 2022, right? In my opinion. And at least that's the message we've given. Right, that they've been incredibly fortunate compared to their peers, and they shouldn't waste this opportunity. They should tune down, think about how it impacts their business, and keep cost levels at a point where they can come out shining in this environment. The second vector is, some businesses and industries are just going to get crushed because of variables that are not in their control, like you said, travel, mobility, which have just ground to an absolute halt.
Yeah.
And then I think there's and some which, like online education, which are just taking off dramatically. And even SaaS enterprise is not trivial. I think a lot of people are in shock and not making decisions. So one has to wait patiently for a month or two before these kind of sectors pick up dramatically. And then everyone, as Renuka said, the best entrepreneurs are super resilient.
Yeah.
They'll figure out how to prune costs, how to take really tough decisions, but survive this and come out very strong, and come out much stronger, I would argue.
Yes, Renuka, as you pointed out, that we've seen downturns in the past. You spoke of 2001, you spoke of 2009, but this perhaps the ferocity with which we've seen the collapse, and we've seen a global collapse both on the supply as well as the demand side. I think that is what is particularly worrying. But at IVCA, what's the LP view? What are you hearing at this point in time in terms of being able to close deals, in terms of being able to fundraise? What's the sense that you get?
So, Shirin, the first task for every member of IVCA is to protect our current portfolio. Just to give a little sense, the total private equity VC money in this country in the last 5 years has been of the order of about $120 billion across about 3,000 companies. So it's a massive task. And to protect these companies, to find more capital, to help our entrepreneurs think about pruning costs, thinking about new partnerships, and to have a life going forward. Here, I would say that our LPs, and I'm equally confident that this would be the same for every other private equity VC fund as well, have been extremely supportive. In one sense, because this is a global pandemic, this is something that has cut across every business in the world, the support is more immediate. If we were caught in a situation where only India was affected, probably we'll be having a different conversation. So my LPs, in fact, even before I could reach out to them, have reached out to me saying, how many of your companies are going to require more funds? How much money are you going to draw down? Do you want to, think about special vehicles and special structures to raise more, in this situation? So it's a very supportive environment, but the responsibility is on us to make sure that at the end of the day, capital is scarce, and this has to be applied to companies which have the ability to make a return on this capital.
Yes,
and it should not be frittered away because of a weak heart.
Yes, capital preservation will have to be one of the keys. But Karthik, you said that in your portfolio, for instance, companies who were lucky enough to have raised money before the COVID pandemic hit us will have no excuse not to be around come 2022. So what are you telling them to do at this point in time? What's, in terms of cost rationalization, in terms of tapping into this post-COVID era opportunity, beyond just looking at what can happen on eking out costs? What's the playbook?
So we took a two-pronged approach. I think one was to, for the lack of a better analogy, let's go with the one of the season. We tried to do sort of herd immunity, right? So we basically took learnings from within the portfolio and even from the unicorns who are not immune from this shock, right? Everybody has to sort of figure out how to survive 6 to 7 quarters and get as close to profitability as possible. So we used, even the smaller companies to understand from the lens of the bigger companies and how to actually, that they're not unique just because they've raised 5 million versus somebody who has 200 million.
Yeah.
The problem sets are kind of similar. So we use that as a first broad brush stroke to educate everyone for the first 2-3 weeks, where everyone is a little bit in shock and awe. Few of them have the deer in the headlight moment and don't necessarily react fast enough. So the challenge was get everybody to understand the severity of the problem. Then the second level approach is to then customize this for every company, because each company is unique on this front. There is no absolute perfect playbook per se. So we are encouraging the balance of additional spends, obviously taking a harsh call on hiring, even a freeze on hiring even if your business is doing very well. And if it's not, and if you have a shock on revenues, you have to take commensurate cuts and you can rebuild. The market's going to be in your favor in terms of talent, in terms of the opportunity. It's not like your competition is going to kill you or outspend you. So it's a very, very sort of, sort of meditative time for most startups to think about how to get the business built right, and not be afraid of variables, which usually they are in peacetime. And so, and so we've been advocating that, and I think once this message was delivered and we waited for a week and then started doing a roundup, we were amazed at how conscious folks had become. There were a company, without naming them, there was a company which had raised 15 million. On day one of the crisis, they said, oh, we can survive 18 months easy. And then they came back 2 weeks later and said, we figured out a plan to survive 30 months, even if our revenue goes to zero for 6 months. And I think that needs to become the equivalent of a playbook that everybody applies, especially in early stage companies where you tend to have more of a, less of a runway or less of profitability relative to, say, private equity companies in Renuka's portfolio, which have a lot more solidity and have bank credit lines and things like that. Here, your only solace is, balance sheets of your existing investors. Everything else is up in the air. It's not really up for discussion in the shop.
Yes. Speaking of things being up in the air, Renuka, I think one of the things that is also causing a degree of nervousness and anxiety is the recent FDI Amendment, which basically says that investments coming in from countries that enjoy a land border with India, ostensibly China, will be put through the government approval route as opposed to the automatic route. Now, we are still awaiting the details. The notification has now been put out. It's a Gazette notification. We're still awaiting clarity on whether this will apply to all sectors or some sectors in specific. What's the IVCA view? Is this a concern that's been raised by people?
Yeah, Shireen, I'll certainly answer this question. But before that, since you raised the issue of playbook, I would say that the first thing for all companies to kind of come to terms with is that we are going to a new normal. So there is no question of looking back and thinking, when will I go back to my old state? Completely abandoning your past and saying, this is my new normal and what can I do from here has been one thing that we have been talking. And the two is dynamic decision making. So in a more steady time, the management teams are used to taking a decision and marching to those orders. What we have told our companies is that every day you're going to get new facts and new possibilities, and therefore prepare yourself and your team for dynamic decision making and a collaborative decision making. So there are some very, very interesting management ideas that are coming to play. People are becoming more good listeners and more resilient and more dynamic in terms of their response to all incremental input. So it's a very interesting time. And as I said, the strong will emerge much stronger. Their resilience will go order of magnitude. They will devise, as to Karthik's point, new ways of saving costs, new ways of reaching customers, and so on. Embrace technology much more to their advantage. So we are going to go to an era where the strong companies are going to become very valuable and very strong sooner than we can imagine. Now, coming to your question about this new guideline, first I want to say, as IBCA, we immensely respect every directive that comes from the government. So our first step is really to understand the spirit behind this circular and whom it impacts. I would say that probably this circular will not impact all the members of IBCA equally, because there are a number of members of IBCA who are operating from this country, where irrespective of from where the capital comes, the ownership is really residing within India. It will impact a few other members, some of them maybe very deeply. So we are first trying to come up with solutions which will make the impact as minimum as possible. First of all, this circular has not necessarily kept in mind pooled vehicles, where the pooling can happen in different geographies, the managements can sit in totally different geographies, who in turn
Yeah.
are really the decision makers and the owners. So we need to unravel this and have a conversation and come to a conclusion. But the underlying uh, spirit of the industry is, number one, this country needs capital. We are sitting on $25 billion of capital already raised pre-COVID, which is waiting to be deployed in India. And we want that process to be really smooth without any roadblocks, because behind this $25 billion of equity, at least a $50 billion of debt can flow in. So we are talking about potentially $75 billion of capital waiting to be deployed. From our past records, Shri, it will be very interesting for you to know that at least 80% of the capital deployed goes back to the government in the form of direct and indirect taxes.
Yeah.
So we're talking about $50 billion of potential revenues for the government. And on an average, we create 2 to 3 million jobs per $1 billion of capital. So we're talking about, anywhere between 10 to 30 million new jobs, 60 billion revenues to the government, and $75 billion of new capital. And I'm very, very confident that IBCA along with the government will work out a way by which whatever is the requirement of the government will be fully respected and honored, and there will be no impediment to bring this capital into this country.
Yes, we will have to see how that plays out. But Karthik, to the point that was being made there by Renuka, and that is where we require clarification, because the press note as well as the Gazette notification basically also talks about the issue of beneficial ownership. How much of a concern is that? And do you believe that that requires clarification as well?
Yeah, I think we're waiting for that, and I guess what will be useful to know, given that historically we have got, at least from the venture space in the last 4 or 5 years, as you're aware, there's been a lot of interest in cross-border investments from our neighboring countries, right? And so they've already taken positions in certain companies, and this money could have come into very large companies with sort of significant ownership, and they've come into even our tiny companies at Series A and a few $1 million. So what I think we are hoping from all the additional clarifications or comments that have come is there's no intent to sort of dissuade that kind of capital. It's just a window that's being set up for us to be able to put an application through and have scrutiny over those kind of investments. So, I don't know if you're familiar that when we invest some of our domestic capital into foreign domicile companies, we have to go through a SEBI approval process, for example. And that takes 3-4 weeks to be able to get. And when we disclose this to all of our stakeholders, including the founders and our co-investors, it's become sort of standard routine to put it through that process.
Yeah.
I think what we'll have to understand is, what does this process entail? And as long as it's business as usual for 90% of the investments, and a certain timeline that gets built for a formal approval, I think we'll all be healthy and hearty, irrespective of the
Yes, we are awaiting clarifications from the government. Renuka and Karthik, I need to take a break, but hang in there. We'll continue this conversation on the startup playbook at this crisis time and what it means for Indian founders and Indian entrepreneurs. Back in a moment. You're watching Young Turks. You're watching the special edition of Young Turks. We're in conversation with Renuka Ramnath and Karthik at IBCA. Renuka, I want to go back to that point that you made about we're entering an era of a new normal. And after every crisis, we do talk about a new normal. Now, what will that mean in terms of social consumption, in terms of behavioral patterns? I mean, one of the companies that you bet on, for instance, PVR, is facing an uncertain future today. We don't know when it will be able to restart its operations, or whether the way that we've been used to going to the movies is going to be something that that will continue as is. Now, how do you navigate through a situation where we don't know how behavior patterns or consumption patterns are likely to change?
Absolutely fair question, Shireen. So as Karthik said, some of these companies are very mature and they are financially very robust. So speaking specifically about PBR, we had just raised equity in the company. So we were fortunate. And sensing that this problem was right around the corner, we had also showed up liquidity in the company through borrowings. Fortunately, because of our recent equity raising and good financial performance of the company, our debt to equity was very, very comfortable. So in PBR, speaking specifically about the issues of not being able to be in large crowded places, malls being shut down, zero revenues, the only solution is to have liquidity on your side, cut down costs to the new normal. As I said, it's not incremental. It's not thinking about should I do a 15% cost cut or a 25% cost cut. It's going down to the basics and say questioning every element of cost and asking why should it be in my P&L in the going forward scenario. Three is not to be very optimistic about when we can open the cinemas and when we'll be able to see cash flows coming to our company. So making a very gradual assumption about when things will come back to normal, what will be the social distancing requirements, so can we fill capacity, in how many of our markets we will have delayed opening, will there be content? So there is this whole supply chain effect, Shireen, which is what is going to be the biggest challenge for every industry when we think about the comeback period of COVID. It's very, very hard for any management to precisely determine how much supply chain disruption has happened. So in PDR's case, it will be a question of how many new movies we can get released because we bring in our patrons into our theaters when we have new movies. And even if there is a new movie waiting to be released, will those producers want to wait for some more time before they launch the movies? Because for them, it's a one-time opportunity to encash all the money that they have invested and all the hard work that they have put in.
Yeah.
So there is a lot to think through for each of our companies in terms of what would be the post-COVID comeback and preparing ourselves for huge supply chain disruptions. And the only weapon in our hand is, as I mentioned earlier, dynamic decision making, thinking about the new normal in a fundamentally new way, and being, I would say, highly realistic, not pessimistic, but realistic in terms of thinking about the post-COVID cash flows when things will come back to normal. But the real challenge for every company in this country is liquidity, and it has been a challenge even in the pre-COVID space. So that problem has got magnified a lot because of COVID.
Absolutely, the liquidity problem getting exacerbated through this crisis. Karthik, I'll give you the final say then. Renuka talked about the need for a greater degree of collaboration. What we saw yesterday with that big announcement, Facebook picking up a 9.9% stake in Reliance Jio, are we likely to see a lot more of this kind of collaboration, especially bringing the Valley closer to India, given the fact that they're not welcome in China? And secondly, consolidation here in India, given the fact that this is trying times, not everybody is going to be able to have enough money, they're not going to have enough of a runway and may not have the ability to raise funds. So will we see forced consolidation?
Yeah, I think it's inevitable. It's always a function of, I wish everything was in the hands of the founder or the board. I think it's always a combination of the two. And, sometimes you have to make your best effort in being able to raise the capital. I don't think capital raises which buy you 3 months or 6 months are going to be sufficient other than to be able to continue those kind of conversations. So it's inevitable that there will be 2-3 different, personas of consolidation. One are obviously good talent not going to waste and getting acqui-hired. So there are always going to be strong companies, even in such scenarios, who want to, not go and rebuild an adjacent business or take over a good team. And we've started hearing the first murmurs of such inbounds. And inevitably, in every portfolio in the venture landscape, there are going to be plenty of those kind of conversations. The second is, where it makes a lot of sense to consolidate the strength of the balance sheets, right? Rather than fighting two different battles. And back in the day when we sold Taxi for Sure to Ola, it was a decision of that nature, where there's only so much you can do to compete in a multiplayer oligopolistic marketplace, and you move quickly to a sort of a short-term duopoly because you can't all be burning and spending that kind of capital. So there's an economic sense in bringing those kind of mergers together. I don't know how many there will be and how many large ones and small ones there will be. They're more likely to happen when there are larger companies which have more dominant balance sheets. Very rarely do you see mergers of equals in this country. And the third is the interesting geo-Facebook phenomena. Yes, it's kind of open ground for the Western Hemisphere to start thinking about whether there's something attractive to buy into in India, given that there is an environment where they might not be flush with new capital to burn. And if they're being very conservative and they're growing slowly, does it make a dent in these strategic investors who could come in and actually take big slices of companies? That said, a lot has been said on your shows and otherwise on Facebook Reliance. I was just doing the math, and it's great optionality, right, for Facebook. At the end of the day, it was about 10% of their cash balances, 10, 12%, and 1.5% of their market cap to buy into 10% of India's jewel in the crown in terms of the Indian internet scenario. So it's a great trade. And, Walmart did this historically with Flipkart, and I wouldn't be surprised if a few more step in as well.
Yes, we may see more of these deals, these mega deals going through, but we'll have to wait to see how this plays itself out. Renuka and Karthik, always a pleasure. Many thanks for joining us here on CNBC TV18 on the Startup Playbook. And I think we are going to have to continue to have this conversation as we see things playing out and the full impact of COVID-19 being absorbed by the economy. But for now, from all of us here on the team, goodbye. Many thanks for watching.